I made my first million at 40, my first billion at 75. You want to know what changed? I stopped doing stupid things. That's it. That's the secret everyone's looking for. Look, everyone's out here chasing the magic formula, the perfect AI stock, the next crypto moonshot, the insider signal that'll make them rich by Tuesday. There is no magic formula. There's just a checklist of idiotic mistakes that will destroy your wealth. And if you avoid them, you win. It's that simple. I spent 60 years watching brilliant people, doctors, lawyers, engineers, destroy themselves financially. Same mistakes, over and over and over. And you're making them right now. 7 mistakes, not 7 tips, not 7 hacks, 7 mistakes that will cost you decades of your life. Most people don't figure this out until they're 65, broke, bitter, blaming the system, blaming the economy, blaming everyone except the person in the mirror. I'm giving you the checklist today. If you're making even 3 of these mistakes, you're already 10 years behind where you should be. Let's see which ones you're guilty of. This is the Munger method. No hype, no predictions, just what works when everything else fails. Let's go. Mistake number 1. You're learning from your own mistakes instead of other people's. Here's your first problem. You think experience is the best teacher. Wrong. Dead wrong. Other people's experience is the best teacher. Your own experience is the most expensive teacher. I'm not smart enough to make every mistake myself. I don't have 300 years to figure this out through trial and error. Neither do you. So I read obsessively. Not self-help garbage, not success porn, failure stories. I studied every major stock market crash, every corporate fraud, every bankruptcy, every bubble that popped and took people's life savings with it. Why? Because the same patterns repeat, the same warning signs flash, the same stupid decisions get made. You think you're different? You think when the next AI bubble bursts, you'll be the genius who sells at the top? No, you won't, unless you study what happened to everyone who didn't. The South Sea bubble happened in 1720, over 300 years ago. People still fall for the exact same scam today. Different name, same stupidity. Tulip mania, railway mania, dot-com bubble, housing bubble, crypto bubble. Now we've got the AI bubble forming in 2026. Same pattern every single time. Mass delusion, this time is different. It's never different. I studied the Great Depression before I was even born. I read about people who lost everything because they borrowed money to buy stocks. Margin calls wiped them out overnight. What did I learn? Don't use leverage, ever. If you can't afford to own it outright, you can't afford to own it, period. I read every biography I could find, not to be inspired, to catalog mistakes. Andrew Carnegie made mistakes. Rockefeller made mistakes. Even Benjamin Franklin got scammed on some investment scheme that went bust. But I don't have to repeat them. They already documented their failures. All I had to do was pay attention. Here's what you do instead. You lose money on some AI meme stock in 2025. You act shocked, like you're the first person to fall for a hype cycle. You buy Nvidia at the top. It crashes 40%. You're surprised. But this happened with Cisco in 2000. It happened with housing stocks in 2007. The information was there. Thousands of books, documentaries, case studies. You just didn't read them. Here's your action step. Read one investing disaster per month. Just one. Read about pets.com and Webvan. Billions raised went to zero. Read about long-term capital management, hedge fund run by Nobel Prize winners who built a model that said they'd only lose money once every 1,000 years. They lost everything in 4 years. Read about FTX and Sam Bankman-Fried. Happened in 2022. $32 billion vanished. Each story saves you from making that mistake yourself. Boring? Yes, but losing your money is more boring. Mistake number 2, you're buying things you don't understand. This one drives me absolutely insane. I have one simple rule. If I don't understand it, I don't buy it. Period. End of story. Sounds obvious, right? Then explain to me why you bought crypto in 2021. Can you explain how blockchain actually works? Can you explain proof of work versus proof of stake? No? Then you weren't investing, you were gambling.
In style. Here's what kills me. You spend an hour researching a $50 toaster on Amazon, reading reviews, comparing features, checking if it has a bagel setting. But you'll throw $10,000 into a stock because some guy on Reddit said diamond hands to the moon and posted a rocket emoji. Makes perfect sense. I passed on thousands of investments, huge winners, companies that went up 50x, 100x, and I slept fine. Why? Because I didn't understand them, and I'd rather miss a winner than lose money on something I don't get. I passed on tech stocks in the 90s. Everyone said I was an idiot. You don't understand the internet, old man. Maybe, but I also didn't lose money when they all crashed in 2000. I passed on Amazon early. Didn't make sense to me. Bezos was losing money every quarter, and people called him a genius. Did I miss out? Sure. Amazon went up 100,000%. Did I lose money? No. And that's the point. When you only invest in things you understand, you avoid 90% of disasters. I never bought Enron, never touched WorldCom, never invested in mortgage-backed securities before 2008. Why? Because I didn't understand them. Or I did understand them and realized they were garbage. Either way, I kept my money. Here's the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. Company makes money. Gives some to me. That's Coca-Cola. Simple. Understandable. Now try explaining, I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms. What does that even mean? If you need 15 minutes and a whiteboard to explain your investment, you don't understand it. Go through every investment you own right now. Ask yourself, how does this make money? If you can't answer in one sentence, sell it today. Mistake number 3. You're in a hurry. You want to get rich by Thursday. Not happening. Never happening. I built my wealth over 60 years. Not 6 months, not 6 years, 60 years. And people ask me constantly, what's the secret to getting rich quick? There isn't one. That's the whole secret. No shortcut, no hack, no loophole. Just time and compound interest. The big money isn't in the buying. It's not in the selling. It's not in time in the market or finding the next Nvidia. It's in the sitting, the waiting, the doing nothing. But you can't sit still, can you? You see someone make 200% on an AI stock in 3 weeks. You panic. I'm missing out. Everyone's getting rich but me. So you start trading, day trading, options, crypto, chasing every hot tip on Twitter and Reddit. 5 years later, you've gone nowhere. Actually worse than nowhere, because you paid fees and taxes on every stupid trade. Meanwhile, the boring guy who bought an S&P 500 index fund 5 years ago and forgot about it, he's up 80%. He doubled his money, doing nothing.
Here's the math you don't want to hear. 20% a year doesn't sound exciting. It sounds boring. It sounds slow. But 20% a year for 60 years turns $10,000 into $560 million. That's not a typo. That's compound interest. Einstein called it the eighth wonder of the world, not because it's flashy, because it works. But you don't want to wait 60 years. You want to be a millionaire by 30. So you take stupid risks. You use leverage. You trade options. You go all in on speculative garbage. And you lose it all. Or you make some money, get cocky, and lose it all on the next trade. You don't need home runs. You don't need to find the next Tesla. You need to avoid strikeouts, hit singles, get on base, don't swing at bad pitches. That's the whole game. But your ego won't let you play it that way. You want to brag at parties. I made 500% this year. You don't want to say, I'm slowly compounding wealth over decades. That's not cool. That's not impressive. But it works, and your way doesn't. Here's your reality check. If you've been investing for 5 years and you're not beating the S&P 500, you're not an investor. You're a gambler with a losing record. The S&P averages about 10% a year, just sitting there, no genius required. If you're doing worse than that after all your research and trading, you're literally better off doing nothing. Buy the index fund. Set it, forget it. Go live your life. Check back in 30 years. You'll be rich. Not exciting, but correct. And here's the brutal truth. 90% of active traders underperform a simple index fund over 10 years. You're not special. You're not the exception. Mistake number 5. You're hemorrhaging money on fees and taxes. This one's boring, I know. Nobody wants to talk about expense ratios and tax efficiency. But it's costing you hundreds of thousands of dollars, maybe millions over a lifetime. Let me show you some math. Pay attention. You're investing $10,000 a year for 30 years. Scenario 1, low-cost index fund, 0.04% expense ratio. Buy and hold, don't trade. At 10% annual returns, you end up with $1.8 million. Scenario 2, actively managed mutual fund, 1% annual fee.
Doesn't sound like much, right? Just 1%. Same 10% returns before fees, but after fees, you get 9% per year. You end up with $1.5 million. The difference? $300,000 gone, vanished into your fund manager's pocket. A 1% fee cost you $300,000 over 30 years, for nothing. Actually, worse than nothing, because most actively managed funds don't even beat the index. So you're paying more to get less. And that's just expense ratios. Now add trading commissions, add capital gains taxes every time you sell for a profit. Short-term capital gains, taxed at your top rate, could be 37%. Long-term capital gains, still 15 to 20%. Most active traders give away 30 to 40% of their gains to fees and taxes. Then they wonder why they're not building wealth. Warren and I obsessed over this for decades. We held stocks for 30, 40, 50 years to avoid capital gains taxes. Why sell? You pay 20% in taxes right off the top. Now you have to find another investment that's 20% better just to break even. Stupid. Berkshire Hathaway doesn't even pay dividends. You know why? Because dividends are taxed immediately. The government takes their cut before you can reinvest it. We'd rather keep the cash inside the company, reinvest it in more businesses, and let it compound tax-free for decades. That's how you build generational wealth.
But what do? You trade constantly. You sell winners too early because you're scared. You hold losers too long because you're stubborn. Every trade equals fees. Every short-term sale equals higher taxes. You're working against yourself. Here's what you do. Calculate how much you paid in fees and taxes last year. Actually do this. Go to your brokerage account. Look at your 1099. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios. If that number is more than 1% of your portfolio value, you're trading too much. Switch to low-cost index funds. Stop trading. Hold for the long term. This isn't sexy. It's not exciting. But it might be worth an extra $500,000 over your lifetime. Pay attention.